The perfect trade in 7 steps. Hello, welcome to a new video. And today I want to walk you through the 7 steps that it takes for you to improve your trading, to find better trades, and to elevate your whole trading to a more professional and to adjust more consistent level. Those are the 7 steps. So what we're going to need before we get started is step 1, step 2, trading plans and checklists, how to use them, what they are, and why they are so beneficial. Step 3, improving trade entries. Step 4, trade management, exits, trading performance, and system design as the last one. And it's really important that you understand that entries and trading entries and indicators, it's not everything. Many amateur traders, or I should say probably the majority of all amateur traders, spend 99% of their time just looking at entries and just trying to improve the way they enter trades or they find trades. But then they will realize that they're not getting the results that they are after, and then they are attributing the loss and the lack of positive results to entries, because that's the only thing that they have spent their time on and they have never looked beyond it. But what we have seen in mentoring hundreds and hundreds and hundreds of traders is that traders who create a holistic approach, who look beyond entries, will improve their trading much quicker. So let's look into this. Step 1, before you get started, what do you need to do, and what is really important is market selection. You need to be very selective in the markets that you trade, whether it is Forex pairs, stocks, futures markets, commodities. You are always able to choose from hundreds or even thousands of different instruments, and you should not make the mistake to try to trade all the markets all the time. You should also not make the mistake of just trying to specialize on just 1 or 2 or 3 markets. You should be very selective when it comes to choosing the right market. And in my trading, I have a set of around 40 to 50 Forex pairs, commodities, and CFDs that I will go through week after week after week. And every week I will pick new ones based on the market conditions, the technical analysis, how does the market react to principles and concepts of technical analysis, which means, are the trends working nicely? Is the market paying attention to support and resistance? And all of those things. I avoid markets where there's a high volatility, for example. I avoid markets where there's no momentum. I look for markets that move nicely, that trend nicely, and that just give me a way to use technical analysis and the tools that I need in my toolbox. Really important. So this is something that many traders can improve on initially. Look at the markets that you trade. How do you choose them? Do you just choose them randomly? Do you just jump from market to market to market until you hope that you are going to stumble upon something that just works? Or do you have really an established approach that helps you find the right markets week after week? And you need to be very selective. Step 2, you need to have trading plans. Really important. A trade should always be based on an if-then scenario. So if this happens, then you're going to do that. And this is based on the criteria in your trading strategy. What are the tools that you use? So for example, let's say the market is moving in an uptrend and you see already that there's a divergence coming up, and your trading plan says if the market breaks into a new low, if the market breaks out of the pattern that you are seeing, then I'm going to enter the trade. And this is how professional traders always set up their trading plans and how they engage or how they take their trades. If then, really important. Amateur traders, on the other hand, what are they doing? They're just moving from instrument to instrument. They're just jumping around until they find something that somehow looks okay, and then they just open randomly a trade. But the professionals, they know in advance what they're going to do, when they're going to do it, and what has to happen in order for them to get into a trade. That's really important, and it also forces you to think about your trading approach. And it forces you to think about what are the things that really matter, what are the things that help you find good trades, and what is the difference between a good trade and a bad trade. That's really important that you spend the time to write it down and write it out. And then you can come up with a checklist Checklists are really important. I think many of you will know the trader Marty Schwartz, who was also featured in The Market Wizards, one of the best traders of all times, probably. And in his book, Pitbull Champion Trader, he mentioned that he is still using checklists even after decades of trading. So if even the market wizard Marty Schwartz uses a checklist, what is your excuse not to use one? So really sit down, think about your trading system, your trading approach. What would really help it also is print out your best 10 trades and look for what do those trades have in common, and then you can write it down into a checklist format. And this will help you to make sure that, first of all, you will understand your trading strategy in a much, much deeper level. And also you can use the checklist then in your real trading to just improve the consistency in picking trades. And it also helps you to avoid errors. When you see that a certain trade is not matching your checklist, you just need to remind yourself that this is a bad trade and you should not take it. Improving exit and improving entry points is step 3. So once you have created your market selection, once you have identified good moving pairs or good moving instruments, you have created your checklist and your trading plan, you know exactly what has to happen before you get into a trade. And then the next step is waiting. Many traders trade way too often, and you need to really be sure that you are developing patience and you are not acting based on FOMO, which stands for the fear of missing out. And traders who are driven by FOMO, they are the ones that get into trades too early, they chase price, they break their rules, and they're just engaging in very, very bad trading behavior. You can read this, Are You a FOMO Trader? And here are the 8 things that a FOMO trader says. I knew it. Just one time, the trader is speculating on a trade, hoping to get lucky. I will just enter with a small position. I know it's not the right trade, and I know I should not be in it, but I just enter with a small position. Something else that FOMO traders will say is that I have a gut feeling that this may happen. I know this is not in my checklist. I know it's against my rules, but I have this feeling, and so on and so forth. You need to be really, really sure that you catch yourself before you let your FOMO take over and before you make the emotional trading decisions. It's really important that you start paying attention to your inner emotions. You cannot shut off your emotions, and trading like a robot without emotions should never be the goal, because it is just not possible. We are human beings. Emotions are an essential part of our nature, and we should not try to suppress them. It always leads to a lot of bad problems and a lot of emotional mistakes when everything blows up, everything comes out at you at once. All the emotions that you have tried to suppress and try to shove back down, at one point they will find a way out, and usually it doesn't end very, very nicely. What helps is, I've seen it in my trading and in the trading from our master class students, is that only enter your trades when the candle is closed. So I completely avoid any trading decision that happens mid-candle. So as long as the candle hasn't fully closed, I'm not going to do anything. And this really helps with picking or avoiding noise, with staying away from fake breakouts or failed breakouts. And it really helps you add consistency in your trading. And although it sounds very simple and it sounds very basic, it can make a very, very big difference. So if you trade a 4-hour time frame, for example, you only look at the 4-hour candles when the market is, or when the 4-hour candle is actually closing. And you try to avoid your charts during the candle. And this will often help with reducing noise. It helps reduce the potential for emotional mistakes. You're not jumping in and out of the trade very, very often. Also, obviously, every trader should have a trading journal. And I hope you all use Edgewonk as the trading journal. At Tradeciety, we are also behind Edgewonk, the trading journal. So if you're using Edgewonk, if you're using a trading journal, really make sure to use Edgewonk. It's edgewonk.com. It's probably, well, obviously I'm a little biased, but it is a trading journal used by many, many traders, professional and amateurs from all around the world. And the great thing about a journal is that it helps you become more objective in your trading review. It's like an invisible mentor practically, because a journal forces you to go over your trades at the end of the day, at the end of the week, And it really forces you to think about the trade and just relive the trade. Once you enter it in your journal, you will often catch yourself thinking, how could I have taken this trade? I know exactly that this is not the trade that I should have been in. Or you will catch yourself thinking, how could I have done this for the 10th or 20th time? I've done this so often. It's losing me so much money. And this is where a journal really comes in handy, because many traders, they never face their problems. They never face their issues. And a journal really forces you to interact and to observe what you're doing every single day. So a professional trader will always have a trading journal. I've never met a profitable trader who doesn't have a trading journal. Step number 4, trade management. Improving trade management and dealing with trade management is very, very important, because we can, or many traders spend lots of time pondering and improving entries, but once they're in the trade, they are completely lost. They don't know what to do because they've never thought about it, and then they screw up their trade, they mismanage their trade, and then they think the entry is not working because they just lost money. Whereas in reality, trade management is really, really important, way more important than entries. There have been famous experiments by Dr. Van Tharp and other people, and they have used a random entry trading strategy. So they flip basically a coin or a random number generator to pick a long or a short entry, and they only made money through the trade management. The entry totally random, and only with trade management they were able to cave out a profit. So it's really, really important that you start to look into trade management more, and you understand and you analyze your trades. How do you manage them? How do you move stops? How do you close your trades? And all of those things. One tip, or the first tip, is don't babysit your trades. This goes hand in hand with the previous point where I said that you don't need to, or that I only take trades and make trading decisions on a candle close. And this is also true for managing trades. Only look at your charts on a candle close and don't babysit your trades. Price can do everything that it's going to do without you. You don't need to look at your account balance all the time. You don't need to babysit your trades. So if you go to the Edgewong Trading Journal YouTube channel, for example, I have done over a dozen reviews of user trading journals. And the one thing that is almost always true is that the traders are losing money with trade management. Avoiding trade management and having a passive approach is often much more profitable. And this shows right away that trade management seems to be a very big issue for many traders. So I challenge you to look at your past 20, 30 or 40 trades and go through those trades and just look at them. How would they have performed if you hadn't interacted with them, if you hadn't interfered, if you would just take the trade, place your stop loss, place your target, and then let the price do its thing. How would the price have performed? And many traders will be very, very surprised about the findings. Objective exit rules is really important. There's this famous quote, the last moment of objectivity is before you enter the trade. And I think this is really true. Once you're in the trade, once you see the market moving, once you see your account balance goes up and down, all the good intentions will go out the window and emotions will take over. So it's really, really important that before you enter the trade, you have exit rules. When you're going to get out, what has to happen before you are closing the trade. That's really, really important. And again, do not trade your account balance. If you are not watching your account as often, or if you're not watching charts as often, if you don't babysit your trade, then the likelihood for interfering with your trades is also less likely, and looking at your account balance and trading your P&L, as we say, is often a huge problem for many traders. When you see that, okay, you are in a loss, you just need to make up for this loss. If you just realize one winning trade, you will be back to break even. So you then try to hunt the trades, you try to force the trades, and then bad things happen. So do not trade your account balance. Just take good trades, regardless of where your account currently is, and don't look at your P&L. This 10-second rule I got from Magnus Carlsen's book, I think, or an interview, where he said, I usually know what I'm going to do after 10 seconds. The rest is just double checking. And we all know how long chess players often look at the board. And this is really, really important, that you don't listen to your gut feeling and just do the action, or just engage in your gut or follow your gut feeling without really thinking about it. Gut feeling should not be listened to in trading, and most of you who are watching this video should never trust your gut feeling. Gut feeling comes after years and years and years of experience of trading profitably. If you haven't been trading for at least 10 years, if you are not profitable, you have no gut feeling. That's really, really important. So before you take a trade, take the finger off the mouse, sit back and think about the trade that you're about to take. Is it really a trade that you should be in, or should you skip the trade? That's really important. Step 5, trade exits and dealing with adversity. So it's really important that you get to understand the role of losses. Losing trades will happen all the time. We see it in our masterclass that when we mentor traders closer and more closely every day, losses and winners, they don't have obviously people look at losses very, very differently, and losses are often interpreted in the wrong way. Many professional traders will trade with a win rate of anywhere between 45 and 60%, which means that on average, every second trade that you take is a losing trade. And this is granted that you take only the best trades possible. So even if you have everything going for you, even if the price looks amazing, the chart looks like your best trade ever, you need to realize that even the best trades can and will fail all the time. And you need to understand that a single loss should never have a big impact on your trading account. If you follow risk management principles, you risk maybe 1 or 2% of your trading account per trade, then one single loss should not have a big impact, neither on your account nor on your emotional capital. You follow your checklist, you follow the plan, you take the trade, and if it doesn't work out, you just get out and you move on. You wait for the next one, but you cannot let one trade get out of hand. Sample size thinking, that is where it's really important, and it helps us to understand losses in a bigger context. If you want to trade as a living, if you want to become a profitable trader and professional trader, you're going to do this for maybe the next 20, 30 years, and you're going to take hundreds or thousands of trades. So you need to really put one trade into perspective. One trade doesn't mean anything. One trade over the course of your trading career is absolutely meaningless. So you need to understand, and you cannot allow one trade to get out of hand. Take a loss, move on. That's really, really important. And if you feel that you are getting emotional after a losing trade, close your trading platform, get away from the screens, and then come back the next day. Don't stay in front of your screen if you always have problems with revenge trading. In the beginning, it may feel like you are just running away, but it will help you to understand that even if you don't make up the money right away, the world will not end. There will be new trades, and you just need to develop coping mechanisms and a better understanding for the role of losing trades. To deal with losses and challenges, I have prepared 5 tips. Reduce your trades, which means risk less on your trades. Many traders that risk too much on their trades have a much harder time to dealing with losses. So reduce position sizing. Become more selective and only take the best trades. The best trades often have a higher win rate, so you can control the variance. Variance is how much your account fluctuates up and down. So become more selective, trade less, take better trades, and then you will have a higher win rate usually. Test your expectations. Expectations are really, really important, because when we have expectations that are just too high and when they are not met, then they will lead to frustration, and they will lead to just bad decisions and just feeling really bad inside. So you need to understand, where are you currently? What is your current status? Are you a new trader, or are you a trader that still is losing a lot of money? Then don't have your expectation to become a profitable trader within the next 3, 6, 12 or 18 months. Instead, try to focus on the next step that are really, really important right now. Don't try to run before you can walk. That's really important. So if you are new and struggling, look at ways how you can improve discipline, look at ways how you can improve your processes, checklist, trading plans, market selection. Also work on your risk management, reduce your position size, avoid the big losses that cost a lot of money. And those are the things that are really, really important for new traders and for struggling traders. Don't worry about the Lamborghini color that you're going to choose on the Lamborghini that you want to buy soon. Objective loss analysis is really important. Not every winning trade is necessarily a good trade. Not every losing trade is necessarily a bad trade. That's really important. You need to have a process-oriented mindset where you look at your trades and you ask yourself, did I follow all my rules? Yes or no? If you answer with yes, then that's all you could have done. Those are the things that a trader really can control. You can control how selective you are. You can control how well you follow your rules. You can control your risk management. What you can't control is what happens after you enter the trade. You cannot control if the price will go up or down. That's out of your control. So don't focus on it. Focus on improving your process and don't worry about the results. Result analysis comes when you have a sample size. After you have taken 30, 40, 50 trades, you can go through your trades one by one and just look at, okay, what did I do right? What did I do wrong? What do the winners have in common? What do the losers have in common? And then you can work on your trading. Then we are coming to step number, okay, here I have a few more points. Avoiding performance targets. So this goes hand in hand with what I said previously and also with expectation management. Having performance goals is usually always a way to really screw up your trading because performance goals are always random and completely arbitrary. How do you come up with your trading goal of I want to make 30% or 50% a year or a month or whatever? Usually it is based on completely random and arbitrary calculations that traders make. If they say, okay, I have a $10,000 account, how fast can I get it to 1 million? And what is the monthly return that I need to realize? This is obviously not how a professional would approach their trading because it's not in your hand. You cannot control how many trades you will get. You cannot control how the trades will perform over time. What you can control is, again, how you organize yourself. How well do you trade? How well do you follow your rules? The rest is out of your hand. So don't have performance goals. Step number 6, 2 key trading performance figures. When you look at your trading and when you want to analyze your trading, there are 2 metrics that are really important, but you need to put them into context or you need to analyze them together. You cannot look at them individually. Win rate, how often do you win? And the second one is reward to risk ratio. And you can only analyze the 2 in combination. You cannot say, I have an 80% win rate, this must be an amazing system. No, it's not true, because even if you have an 80% win rate, if you just have one winning trade, if you just have one losing trade that completely gets out of hand and where you lose all your money, then obviously even a high win rate won't help. On the other hand, if a win rate or a trading system with a 50% win rate can make you a lot of money if your winning trades are just large enough. So win rate alone has or cannot provide any information about the quality of a trading system. You need to understand and you need to analyze this in combination with your reward to risk ratio. How big are your winning trades? How big are your losing trades? And then you can understand how well your trading performs. The holy grail, as I put it, is reward to risk ratio meets win rate. That's really, really the most important thing, because it quickly shows you that you don't need a high win rate, you don't need a high reward to risk ratio. It's just about putting the metrics together. So if you have a trading system with a historical win rate of 50%, your minimum reward to risk ratio needs to be 1:1 to just break even. If you have a 50% win rate and a 2:1 reward to risk ratio, you will make potentially a lot of money, because if you just do the math, then this will provide a positive expectancy. And even with a win rate of 40%, you just need to have a 1.5:1 reward to risk ratio, and then your trading system will perform at a break-even level. So get away from the idea of trying to trade with 100% or even 90 or 80% win rate and have huge winning trades. It's not necessary. System design. The last step, you need to ask yourself, the trading strategy that you are using, the trading approach, is it really aligned to my values, to my way of thinking, to my emotional profile? You need to ask yourself, what suits you? Are you a technical trader? Do you like the higher or the lower time frames? And there's a huge difference between the time frames. Low time frames, you need to be very, very quick with emotional recovery on the lower time frames, because you get so many decisions in a day, you get so many trades in a day. You need to be very good at decision making or at fast decision making. You need to be very emotionally resilient, because after losing trade on the lower time frames, you just need to move on and trade unaffected. And this is very different from the higher time frames, where you have fewer trades, you are very long in your trades, so you need to be good at holding trades. You need to be good with patience. You need to wait longer. So you can see the set of requirements is very different. So you need to ask yourself, the time frames that you're choosing right now, did you think about it consciously? Did you really make a conscious decision, or you just picked it randomly? It's really important that you find the time frames that work with your overall way of thinking, because this really controls everything in your trading. Obviously, you then can also look at position size, how wide or how strong is, how large is the position size, and how does it contribute to variance in your trading account. You have a high win rate and a small position size. You will have small winning trades, but it's a more steady climb. You have a high win rate and a large position size. Your account will have moderate swings. You have a low win rate and high position size. Your account will experience huge swings. So all of those things go hand in hand. Position size impacts your trading account, reward to risk ratio as well, and win rate. So you need to put them all together, and you need to make sure that you have a moderate, you have a conservative approach. Don't risk more than 2% of your capital on your trades. It's really important. And also be very realistic with your win rate and with the reward to risk ratio that you're going after. It comes back to expectation management. If you have the expectations to have a trading system with a win rate of 80 or 90%, it will usually always destroy you, because this is very unrealistic to find. And if you cannot find such a system, you will always be restless and you will always just keep searching for the next one. Whereas you could make a lot of money with a trading system that has a lower win rate. So make sure that you understand the combination and the connection between all of those parts. And that's it. I hope you enjoyed this video, 7 steps. Go through this. I will also link this article underneath this video, so you can read up on it step by step, and you can establish a process for your own trading. And if you like this video, make sure to leave a comment in the description below, leave a thumbs up if you watched it till the end, and you will hear from me in the next video.